All right, let's jump right in. We're going to talk about something that could be costing your business a serious amount of money, maybe without you even knowing why. It's called the Assigned Risk Pool for Workers' Comp. But more importantly, we are going to lay out a clear guide to getting you much, much better rates. So, does this hit close to home? You look at your workers' comp bill and the premium just feels completely out of whack, maybe even unfair. Well, you're definitely not alone, and there's a very good reason this might be happening to you. That ridiculously high premium? It's probably because you've landed in what the insurance industry calls the market of last resort. You might hear it called the residual market, the state fund, or most of the time, the assigned risk pool. And let me be really clear about this. One of our sources put it perfectly. This is not a pool you want to be anywhere near. Yeah, it's a safety net, but it's a safety net that comes with a seriously steep price tag. Okay, so what is this thing really? Let's unpack what the assigned risk pool is and, why it even has to exist. The easiest way to think about it is that there are two different markets for insurance. You've got the main one, the voluntary market, where all the insurance companies are competing for your business. But if no one in that market is willing to cover you, the state has to step in with the assigned risk pool. It's basically a system that assigns your business to an insurance carrier, and that carrier is then legally required to cover you. And that really gets to the heart of why the pool is necessary in the first place. Since pretty much every state legally requires you to have workers' comp, there has to be a way for every single business to get coverage, right? Even the ones that seem super high risk. The pool makes sure that everyone can follow the law and protect their people. Now, to really understand what it means to be in the pool, you have to see just how different the clients are in the voluntary market versus the assigned risk market. It's truly like a tale of two completely different worlds. The difference here is pretty stark, isn't it? On the left, that's the dream client for an insurer. They've been around, they're stable, they're safe. But on the right, well, you see all the red flags. New businesses, lots of employee turnover, a spotty claims history, or just being in a dangerous line of work. If your business profile looks anything like the column on the right, you're way more likely to wind up in the pool. So, the big question is, how did your business end up there? Let's dig into the most common reasons this happens. It almost always comes down to one of three things. First, you're a new kid on the block. Insurers live and breathe data, and if you don't have a track record, they just can't predict your risk. Second, you're in a high-hazard industry. That's a big one. And third, you've got a history of claims, which is a major signal to insurers that you might not be a profitable risk for them. And listen, this isn't just a guess. The data from NCCI shows you exactly what's happening. Look at this. Carpentry, roofing, painting, trucking. These are the exact kinds of businesses that often end up in the pool simply because of the risks that come with the job. All right, so we know why you might be in the pool. Now let's talk about the part that really hurts. What is this actually costing you? Let's put a number on it. Just let that number sink in for a second. 60%. That is how much more a business in the pool could be paying for the exact same coverage. In this case, for a super low-risk office job, than a business in the voluntary market. The rates are just fundamentally, significantly higher. And it's not just that base rate either. You also miss out on all the discounts you might normally get. You have zero bargaining power. And you can get slapped with extra surcharges, like something called an Assigned Risk Adjustment Program, or ARAP, if your claims are worse than expected. It just keeps adding up. Now, while the cost is high, there are at least some ways to manage the cash flow. Most plans will offer you payment options. If it's a smaller premium, you might have to pay it all up front. But for bigger ones, you can usually put down a deposit and pay the rest in installments. And some states have programs like pay-as-you-go that tie your payments directly to your actual payroll, which can help. Okay, this brings us to the most important part of this whole conversation. You are not stuck here. Let's build your action plan to get out of the pool and back into the affordable, competitive market where you belong. So here's the bottom line. Getting out of the pool takes a real strategy. There are absolutely no shortcuts. And that strategy almost always starts and ends with how you handle workplace safety and your claims. That's the root of the entire problem. Here it is, your 4-step roadmap. Number 1, analyze your situation. You need to know exactly why you're in there. 2, put a real, effective safety program in place. 3, get a handle on any claims that do happen. And 4, all this hard work is aimed at one key number: improving your experience modification rate, your EMOD. This EMOD, it's basically like a credit score for your company's safety record. It's a number that literally compares your claims history to the average for everyone else in your industry. If your number is below 1.0, it means you're safer than average and you get a discount. If it's above 1.0, you're riskier and you pay more. Getting out of the pool means driving that number down. But, and this is a really important detail you have to know, there's a time lag. The data used to calculate your EMOD is actually a year old. So that amazing safety program you start today, it won't actually lower your premium for another year. The message here is crystal clear. You have to start now to see the benefits later. The best news in all of this is that you are in the driver's seat. It's going to take work for sure, but with a real, focused plan for safety and claims, you can absolutely prove to the insurance world that you're a good risk and graduate back to better rates and better options. I absolutely love this quote from one of the sources because it's the perfect way to think about this. Being in the pool is not a permanent sentence. It's just a very, very expensive detour. And at the end of that detour is exactly where you want to be, a place with lower premiums, more choices, and better coverage for your business. It is totally achievable. So I'll just leave you with this question to think about. After everything we've just talked about, what is the first single concrete step your business is going to take starting today to begin its journey out of the assigned risk pool for good?